I love paying taxes just as much as the next guy. So now's that time where we're meeting with our tax professionals. If you don't have one, I highly recommend our Diversified LLC tax company. They're a great group of guys and gals that know their stuff and can really help integrate your experience with us. And even if you don't use us, feel free to reach out to them. That said, I was talking to Ed Lynch, who runs the company there, and our head CPA, and we were talking through some last minute tax strategies the other day. And there are really three great ones that you can still do for 2021 as it's getting that time of year to meet with your tax professionals and file your taxes. The first is a really interesting one. So the Department of Delaware, Department of Revenue for Delaware, has put out a ruling for the year. And check your state. So every state's handling it differently, but Delaware put out some good verbiage that really helps a lot of our clients. So if you worked from home last year and you worked out of state from home, more specifically, so for instance, I live in Pennsylvania, my office is in Delaware, and we mandated that everyone work from home or highly suggested it. Those are the two criteria. You can claim those days that you worked from home out of state on your W-2. So what does that mean? Let's say you make $100,000 and you work from home all of last year. You, instead of paying Delaware's almost 6% state tax, you can pay Pennsylvania's 3-ish tax and save almost 3% on your state taxes. So $100,000 income, that's $3,000 savings. $200,000, $6,000 savings, ballpark. So again, I know the ruling for Delaware, and so if you fit that criteria, highly look into it or talk to our tax team. And if not, and you're watching this from another state and you fit, again, that sort of work from home out of state situation, look into it. So that's tax tip 1. Tax tip 2 is IRA and Roth IRA contributions. So this cuts a lot of ways. So you have until April 15th to make a previous year, so 2021 IRA or Roth IRA contribution. Now, you got to check the rules to see if A, you're even eligible, but if you are, consider it. So you can go into a Roth, $6,000 if you were under 50 and a $1,000 catch up, or an IRA if you want the pre-tax benefits. Now, of course, there's the strategy of the backdoor situation, which is you still, let's say you maxed out a 401k and you're not eligible, you can still make a non-deductible IRA contribution for last year, right now in 2022, and convert it to a Roth contribution, effectively still making a Roth contribution for the previous year. I love doing this strategy. It's a great one. Who knows how long it'll stick around, but for now you can still do it. So consider it. I highly suggest considering it. There's a lot of tricks to it though, so definitely consult with your tax team and your planning team. All right, final tax tip that you can still implement is HSA contribution. So much like the IRA, you can still make a HSA contribution for the previous year up until April 15th, and that's HSA stands for Health Savings Account. This is not a FSA, flexible spending account. You don't have to use these funds before year end. They can sit there virtually forever. And oh, by the way, HSAs are the best thing since sliced bread. They are triple tax savings. Before tax, come out tax-free, grow tax-free. So they're fantastic. $3,600 if you're single, $7,200 as a family. There's an additional, I believe, $1,000-ish catch up if you're 55 or older. So look into the HSA contribution from last year, top that off. I highly suggest it. So those are the tax strategies that I am a big proponent of, and I hope that you enjoyed this. So as always, I'm Andrew Rosen. If you like what you heard, follow along. If you like what you heard and want some advice on taxes, give us a ring. Look up diversifiedllctax.com and see how we can help. As always, I'm Andrew Rosen. Stay wealthy, stay healthy, and stay happy. Bye.